Hello there, welcome to our channel. In this video, we will discuss concepts related to the forward foreign exchange rates with a focus on the interest rate parity theorem or the IRP. We will discuss the IRP theorem along with forward rates, forward points and covered interest arbitrage. So let's get going. Let's start with the interest rate parity theorem or the IRP. The IRP theorem helps you calculate today's forward rate of a currency pair based on the spot rate and the interest rate in the respective countries. Let's take the example of the USD Singapore dollar to understand the relevant concepts. Note that the United States dollar is the base currency and the Singapore dollar is the counter currency in this quote. The 1-year forward USD SGD rate today can be more than the spot rate or less than the spot rate. If the spot rate is 1.45 today, the 1-year forward price today can be 1.46 or 1.44 or whatever. In other words, USD SGD forward can trade at a premium or a discount to the spot rate. The difference is called forward points. Note that forward exchange rate is equal to the spot rate plus or minus the forward points. Therefore, forward points is equal to forward exchange rate minus the spot rate. The forward points could be positive or negative depending upon whether the forward exchange rate is greater than or less than the spot rate. When forward points are added to the spot rate, we say that the forward rate is at a premium. This is because when forward points are added to the spot, obviously the forward rate will be more than the spot rate. On the flip side, when the forward points are subtracted from the spot rate, the forward rate is less than the spot rate, or we can say that it is at a discount. This premium or discount is from the perspective of the base currency. Things are different from the perspective of the counter currency. Now, how do you calculate the forward points or the forward rate? The value of the forward points or the theoretical premium or discount can be calculated from the interest rate parity theorem. The formula of the IRP is based on the theory that ignoring transaction costs, the forward premium or discount should be equal to the difference in the national interest rates for securities of the same maturity. If the interest rate parity relationship is violated, arbitrageurs can make risk-free profits in the foreign exchange markets. Ultimately, their actions will force the forward and the spot exchange rates back into alignment with the IRP. According to the IRP theorem, the relationship between the spot rate and the forward rate is as follows. Forward rate F is equal to the spot rate S multiplied by 1 plus RC into n by 360 divided by 1 plus RB into n by 360, where RC is the interest rate of the counter currency and RB is the interest rate of the base currency. N is the number of days for which the forward rate is being calculated. Note that in the USD SGD quote, USD is the base currency and SGD is the counter currency. Also note that the interest rate of the counter currency is in the numerator of the formula of the IRP and that of the base currency is in the denominator. This is easy to remember. You can remember that the base is below in the denominator in the IRP theorem formula. Finally, you may have noticed that the number of days in a year is taken as 360 instead of 365. Normally, the currency of the country with the higher interest rate will trade at a forward discount. That means the forward rate is going to be less than the spot rate. And the currency with the lower interest rate will trade at a forward premium. That is, the forward rate should be greater than the spot rate. For example, the 90-day forward rate for USD SGD today will depend on 4 factors. The USD SGD spot rate today, say 1.45. The interest rates in the USA, say 7% per annum for risk-free treasury bills. The interest rates in Singapore, say the SORA at 5%. The time period, let's say 90 days, where 1 year is taken as 360 days. Based on the IRP, the 90-day forward USD SGD rate will be 1.45 into 1 plus 5% into 90 by 360 divided by 1 plus 7% into 90 by 360. Here 5% is the interest rate of the counter currency, which is the Singapore dollar, and 7% is the interest rate of the USD, which is the base currency, that is in the denominator. 90 is the number of days for which we are calculating the forward rate. Solving this, we get 1.442875. The forward points, which is equal to the forward rate minus the spot rate, comes to 0.007125 with a negative sign. Note that the Singapore dollar is the currency of the country with a lower interest rate, that is 5%, and USD is the currency of the country with a higher interest rate, 7%. Therefore, the 90-day forward rate comes to 1.45 minus 0.007125, which comes to approximately 1.442875. Since the forward points are subtracted from the spot, USD, the base currency, is trading at a forward discount to the SGD. We can say that USD is expected to depreciate against the SGD. The SGD is trading at a forward premium to the USD, or we can say that it is expected to appreciate against the USD. These facts align with the IRP because the currency of the country with the higher interest rate, US, is trading at a forward discount, that is, the forward rate is less than the spot rate, and vice versa. Let's look at the concept of covered interest arbitrage with the GBP USD currency pair. We'll use the interest rate parity theorem to understand this concept. Let's look at the example to understand the covered interest arbitrage, where the rate for the US dollars is 6% per annum and rate for the GBP is 5% per annum, and the GBP USD spot is 1.50. Now, based on the IRP, the forward price for a 1-year contract is USD 1.5 into 1.06 divided by 1.05. This comes to USD 1.5143 per GBP. Note that we are using annual rates with n is equal to 360 in the IRP formula because we want to calculate the 1-year forward rate. Let's see what happens if the IRP relationship is violated. Suppose the forward price is USD 1.5100 instead of USD 1.5143. An arbitrager can make profits by using the following strategy. Borrow GBP 1 million for 1 year at 5% per annum. And after 1 year, the arbitrager will need to repay this GBP 1 million with 5% interest, which will come to GBP 1.05 million. Convert the GBP 1 million borrowed into US dollars at the spot exchange rate of 1.5 to get GBP 1 million into 1.5, which is equal to USD 1.5 million dollars. Then you invest the USD 1.5 million at 6% interest per annum, which is the applicable rate for the US, to get USD 1.5 million into 1.06, which is USD 1.59 million at the end of 1 year. And then enter into a 1-year forward contract to buy GBP 1.05 million. This is the amount the arbitrager will need to repay after 1 year. And this forward contract will be entered into at a forward price of 1.5100. At the end of 1 year, the arbitrager will need to pay GBP 1.05 million into 1.5100, which is equal to USD 1.5855 million, to get the desired amount of GBP 1.05 million. After 1 year, the arbitrager will close his position as follows. He will receive USD 1.59 million from his USD deposit. He will spend USD 1.5855 million to obtain GBP 1.05 million at an exchange rate of USD 1.51. Use the GBP 1.05 million to repay the principal and the interest on the GBP 1 million loan. To summarize, he will receive 1.59 million US dollars and spend USD 1.5855 million, making a net profit of USD 4,500. Effectively, the arbitrager has sold GBP position at 1.5143, the forward rate as per the IRP. The 1.5143 rate was achieved because 1.59 million divided by 1.05 million is equal to 1.5143. And the arbitrager bought the GBP in the forward market at a lower rate of 1.5100. Since the selling price was more than the buying price, he made a profit. The arbitrage was accomplished by simultaneously borrowing in one currency, investing in another currency, and covering the exchange position in the foreign exchange market. This is riskless because the profit was certain at the outset. Let's now discuss the forward foreign exchange contract in a little more detail. As we know, the forward exchange rate F is equal to the spot rate S plus minus the forward points. Therefore, F minus S is equal to plus or minus the forward points. Now let's rearrange the IRP formula to get the formula for forward points. We know that as per the IRP, the forward exchange rate F is equal to the spot rate S into 1 plus RC into N by 360 divided by 1 plus RB into N by 360. If we subtract S from both sides of this equation, we get F minus S on the left hand side, which is basically the forward points. On the right hand side, we get S into 1 plus RC into N by 360 divided by 1 plus RB into N by 360 minus S. The forward points is equal to S into 1 plus RC into N by 360 divided by 1 plus RB into N by 360 minus S. With a bit of mathematics, when we take S common, we get S into 1 plus RC into N by 360 divided by 1 plus RB into N minus 360 minus 1. After solving, we get the formula for forward points as S into RC minus RB into N by 360 divided by 1 plus RB into N by 360. Note that the forward points are only a reflection of the relative interest rates of the currencies. They are not an indication of what the future spot rate of the currencies will actually be. Let's take an example to understand the calculation of forward points. Let's take our USD SGD example to calculate forward points. Remember that the prevailing rates were as follows. Spot USD SGD equal to 1.45, RB is equal to RUS, which equals 7% per annum, RC, the rate of the counter currency, Singapore dollar, is 5% per annum, and N is 90 days. The USD SGD forward points is equal to S into RC minus RB into N by 360 divided by 1 plus RB into N by 360, which comes to 0.007125 with a minus sign. The minus sign indicates that the relevant base currency, the US dollars, should trade at a forward discount. Based on the spot rate of 1.45, the forward rate is equal to 1.45 minus 0.007125, which is 1.442875. The 90-day forward rate of USD SGD will be quoted at a discount. Here we end this video. If you want to ask any questions, you can write to us at wiseatfinance@gmail.com, or you can write in the comments section below. Thanks for watching and happy learning.